1031 exchanges. When selling investment property, you may delay paying capital gains taxes by using the tax approach of a 1031 exchange. The idea behind this tactic is to use the money from the sale of one property to fund the acquisition of another comparable property. The capital gains tax won't be paid until the new property is sold. Working with an experienced tax expert is highly recommended to guarantee that your 1031 exchange is carried out in accordance with all applicable laws and regulations. A 1031 exchange, named after Section 1031 of the U.S. Internal Revenue Code, is a powerful tax deferment strategy used in real estate investment. In a nutshell, it allows an investor to sell a property and reinvest the proceeds into a new property, deferring capital gains taxes that would normally be due upon the sale. Here's how it works. Sell property. The investor sells a property, referred to as the relinquished property. Identify replacement property. Within a specific time frame, usually 45 days after the sale of the relinquished property, the investor must identify potential replacement properties. Purchase replacement property. The investor acquires one or more replacement properties using the proceeds from the sale of the relinquished property. This purchase must be completed within 180 days after the sale of the relinquished property. Tax deferral. By completing these steps in accordance with Section 1031, the investor can defer paying capital gains taxes on the profit made from the sale of the relinquished property. Instead, the taxes are deferred until a later date when the replacement property is sold without undergoing another 1031 exchange. Here are some key points to consider. Like-kind requirement. Both the relinquished property and the replacement property must be held for investment or business purposes, and they must be of like kind, according to IRS regulations. Fortunately, most real estate properties in the United States qualify as like kind. Qualified intermediary, QI. To ensure compliance with IRS regulations, a qualified intermediary is typically used to facilitate the exchange. The QI holds the proceeds from the sale of the relinquished property and uses them to purchase the replacement property. Timing. Strict timelines must be followed for identifying and acquiring replacement properties. Failure to adhere to these timelines can disqualify the exchange from receiving tax-deferred status. Tax consequences. While a 1031 exchange allows for the deferral of capital gains taxes, it's important to note that it's not a tax avoidance strategy. Taxes will eventually be due when the replacement property is sold without undergoing another 1031 exchange. However, by continually reinvesting in like-kind properties, investors can continue to defer taxes indefinitely. Overall, a 1031 exchange can be a valuable tool for real estate investors to defer taxes and potentially increase their overall investment returns. However, it's essential to work with experienced professionals, such as tax advisors and qualified intermediaries, to ensure compliance with IRS regulations and maximize the benefits of the exchange.